But we're going to go ahead and get started today. Noelle, is Angie on today?
No, I'm here in her place, but I do
All right.
have some stuff that I would like to mention for everyone. First of all, happy
Absolutely.
Monday, everyone. I hope you guys had a good weekend. First thing is tomorrow, so Tuesday the 15th, we're having an open houses direct in-person class here at our High Street office. So if anyone is interested, that'll start at 1 p.m. So just message me in the comments if you would like. And then reminder that Tina Tambor is on the 17th, this Thursday, at 10 a.m. that we do. So if anyone wants the link for that. And last thing is Pinnacle Peak Luxury Home Tour is this Friday. I know that, like Sean said, with this season, not everyone's always going to be there, but those are always nice. So if you guys want to join, just let me know. I have the links for you.
Perfect.
Also, Sean, can I add?
Yes, go ahead.
Okay.
Jump right in.
Can I add that we have postponed the Feed My Starving Children volunteer date to December 1st. It'll be on Thursday from 4:30 to 6:15. So if you're interested in doing that with us, Emma, I see you're on here and I already have you down on that. But if you're interested in doing that, we usually take about 15 to 20 agents with us. It's a really good time. Just let me know.
All right, everyone.
All you.
Well, welcome back, Christy. It's been a minute. Christy was on a vacation on a cruise, and then she got an early Christmas present of COVID.
It was horrible.
So welcome back, and it's good to have you back. That's for sure.
Thank you. It's good to be back.
Absolutely. So we're going to get right into it. You guys all may have heard. I mean, it was the shot heard around the world, I guess you could say, in a weird way. But we saw a pretty good day last Thursday. Now the markets were closed for Veterans Day on Friday, and then there's a long weekend. But some exciting news to share with you, and I'm just going to get right into it and share my screen. And bear with me one moment here. All right, so today's Monday morning mortgage update. November 20. Can you believe the year's almost over? I mean, this has been quite the year. Lots of ups and downs, but let's get right into it. So today's agenda, we're going to be going over inflation, like where are we now? We're going to go over a recession, kind of what that means. The Fed announcement. Wow, a couple of these went out of order here. Rates. And look at this, inventory, prepping for the week, mortgage product of the week. We're going to go over the buy downs and making sense of them, because there's a lot of people that just don't understand how to calculate costs for the temporary buy downs and the permanent buy downs. They know kind of how it works. They know it's helpful to get a lower rate, but how do you actually negotiate with the seller the dollar amounts? Like, how do you do that? If you can't get a hold of a lender immediately, it's probably because you're not calling me, but if you can't get a hold of a lender immediately, like, what do you do? So we're going to go over that as well. And then inventory, preparing for this spring. I'm going to go over the trends that are happening with my team and with other mortgage people that I know, and it'll be exciting for you. I promise you that. So let's just jump right into inflation. I've shown you this chart for a while now. And here's what I want to focus on. This number right here, this 0.6 is where we were last year. We just replaced this 0.6 inflation. This is the monthly consumer price index. This is 0.6. We replaced this with a 0.3. That is really, really good news. So what does that do to overall inflation? It brings it down. So we took a little trajectory downward on inflation. Now the markets were incredibly happy. This was last Thursday. They were incredibly happy. I'm like, when I say happy, we haven't seen a reduction of this size in inflation in a long time. And what is the one thing that I always tell you guys? Inflation is the enemy of interest rate. So long-term mortgage rates. So when we see inflation go down, what happens with rates? They go down. Regardless of what the Feds are doing, that rate is separate. Inflation is what drives interest rates. So that's really good news. That's why we saw such a huge market move. Now I want to show you one of the biggest parts of inflation is lodging, and lodging away from home. If you look back into a normal market, the seasonal moves on lodging away from home, which is part of the core producer price index, that's part of inflation. Look how crazy it is right here. If you go all the way to where we were right now, we are really, really high on the inflation side for lodging away from home, that's 32% of the core of the CPI. That's 32% of inflation is lodgings. So we want to be very cognizant of this, because this means if we come back down on this, we're going to see a nice continual downward push on inflation. So you may have not seen this before, but this is the inflation rate for lodgings over, and usually it's seasonal, but look at the, I mean, if this was a cardiologist, you'd probably saying we're having a heart attack right now. But lodging will come back down, and housing is a big chunk of the overall inflation. So like I've talked about in the past, the recession is going to be here. Employment is a lagging indicator, and these are the employment numbers that we just saw. So initial claims was 225,000. So that's gone up a tick, but the continuing claims continues to go up a tick as well. So as unemployment rises, that's when you'll start to have people accept the fact that there is a recession. And the Feds, what they're really doing is slowing down the motor of the economy by raising the short-term interest rates. That's what they're doing. They're doing this on purpose. Powell's said it multiple times. It's going to get tough, and he expects unemployment to go up. So what is happening? So here's a group of, oh, I got cut up a little bit. Twitter is cutting 50% of its workforce. We kind of saw what happened there with the buyout. Facebook is cutting 13%. Look at all these cuts: Snap, Shopify, Netflix, Microsoft, Salesforce, Robinhood, Tesla. These are all companies that are slated to cut jobs. So when we're looking at, is there going to be a recession? This is proof in the pudding that all of the companies and the markets are expecting it, and they're getting ahead of it to cut costs so that their overall numbers can stay positive. And this is just how recessions work. Now, every single one of these people losing a job, unfortunately, means there may be a move associated with it. So when people sell and move, that's another transaction. So that's why if you look at recessions over the past, you'll see that real estate and the amount of volume of real estate doesn't really change. Sometimes it actually goes up because of all of the volatility in the moving around. And then just now, Amazon has announced a hiring freeze. Apple's pausing almost all of its hiring, and Google is cutting it by 50%. So recession is here. Job weakness is here. We're going to continue to see that. And this is what happened to the bond market. This is that bounce upward that we saw on Thursday of last week. This was 208 basis points. Now, a move like that does not happen very often. Now, you probably saw on social media all these people claiming that rates got almost 1% better in rate. It wasn't that much, but it was significant. It was just over 0.5% in rate on the actual cost basis. So 0.5% in rate means it went from like 7 1/8 to 6.625. So there's a pretty significant drop there. And obviously rates are very unique to the buyer itself based on how much they're putting down, the property type, the occupancy. So when you hear rates are a specific amount, take that with a grain of salt, because there's a lot of factors that go into the actual interest rate you're getting. And if this is a primary residence, 30% down, 600,000 loan amount, 800 credit score, perfect creme de la creme buyer, yes, you're going to get the best rate. So what do people advertise? Usually the best rate. So keep that in mind. So let's have a look at rates. Here's Mortgage News Daily. I like to show this because this is a non-biased approach to what interest rates are. So we went down from 7 1/8 on last week to 6.625. So that is a 0.60 change in rate. That is significant. So yay, we're all excited for that, right? Now, could this be the beginning of something better? We'll get into that just shortly, but 15-year fixed, we're in 6s. So guys, you can get rates in the 5s now with a buy down pretty easily, especially on a 15-year. And the 30-year is pretty low. I mean, these are good numbers. Now, this is crazy. It's psychology, right? If we saw these numbers a year ago when rates were in the 3s, people would say, pound sand, there's no possibility of me getting a mortgage right now. That's just not going to happen. Well, right now, guess what? People saw rates in the 7s and they thought they would go to 8. And now they're looking at this thing, seeing it's the best thing since sliced bread. So psychology has a very big impact on the emotions and the behavior of people. And it's amazing how short of a memory we have. So I want to talk to you about buy downs. Buy downs are a very big part of our business on how we are listing properties, how we're marketing the properties, but what are the details? Like, how do you actually meet with a seller and say, yes, we're going to do this. Now let's crunch numbers. Like, how do you actually do that? What are the tools that you can use to make sure you're negotiating properly, and which program is going to be the best? Like, how do you know which buy down, a temporary or a permanent buy down? How do you know which one to use? That's what I'm going to go over now, because I want you guys to be the experts in this, because I believe right now, as rates drop, I really think that the temporary buy down is a great answer. And I'll go over the details, the pros and cons in just a second. So how do you use buy downs? This is how a rate sheet looks like for a permanent buy down. Now, let me just tell you, the permanent buy down is buying down the rate for the entire life of the loan with upfront points. Okay. That is spending as much as you want to buy down the rate as low as you possibly can get to get the absolute lowest rate possible permanently. So on this rate sheet, now, again, this is not specific to everybody. This is just a one rate sheet. At 6.625, the price is 100.03. That means there's a slight lender credit. Anything over or below 100 is a credit or cost. This is above, so it's a credit of $225. Now, if you wanted to go down to 5.25, you can on a 30-year fixed. Here's the cost: $54,292. It's significant, right? So if you go in the middle, that's kind of where people are saying, so to buy down to like 5.75, it's 4% of the loan amount. That's $33,000. This is the cost that you ask the seller to pay. So if you want to permanent to 6, it's $23,775. That's what you ask for. This is the cost associated with a permanent buy down. You can get anything you want. You can negotiate any rate you want, depending on what the seller is willing to give. And sellers, you can advertise this as far as what we're willing to give and what the payments would be compared to a normal one on a different listing. So that is a permanent buy down. The next one is a temporary buy down. Now, a temporary buy down is, the rate is always going to be, in this case, this is based on 6.75. The note is 6.75, but you are going to be temporarily buying the payment down. The first year, this is a 3-2-1 buy down. The first year is 3.75 right here. Oh, go back. 3.75. The second year is 4.75. The third year is 5.75. And then it goes to the normal 6.75 for the remaining term of the loan on a 30-year fixed. So how do you calculate what it's going to cost to do this? It's actually very simple. If you have an Excel spreadsheet, you can build it. The savings associated with the lower payment is exactly equal to the cost. So as an example, the monthly savings by a 3.75 is on the new payment is $1,205 a month. That's significant. That's why this is a great program, because it really helps you. $1,205 times 12 months in the year, that's a $14,000 savings over that year. The second year is not as much, $825 savings. You multiply that by the whole year, that's $9,900 in savings. Third year, it's less, $422 a month, that's $5,000 savings. So in this, you add up all of the savings, and that's the cost. That's how the temporary buy down works. So it's not anything magical. It's just a matter of figuring out what the savings is and then adding that all up. That's what it's going to cost your seller to offer the 3-2-1 buy down. If you need me to calculate these for you, we have a fancy dancy calculator I can use. So I'd happy to do that for you and send this to you and make some reports on it. But that's the major difference. These are the costs for the permanent. These are the costs for the temporary. Now you may say, well, what's the benefit? Like what should I do? Which one should I do and why? That's what I want to talk about, because when you're not talking with your buyers and your sellers, what's going to make the most sense for buyers in today's market? So I put together pros and cons. So based on a permanent buy down, What are the pros and what are the cons? The pros are it's a lifetime of savings. You're not going to just save the first 3 years. You're going to save for the entire length of the home. And if you believe, if you're a skeptic that thinks the rates will never come down, regardless of everything that you see in the markets, this would be the program for you. If you would sleep better at night, knowing that your rate will always be this and will never go up in the future, this is what will work for you. Now, with a permanent buy down, one of the pros is that you qualify at that lower rate. You will always qualify at the lower rate when you permanently buy down the rate. Now, this does save more money over the long term. And it's easier to understand because we say this is your rate forever. There's not an ambiguous how much you're going to save, try to figure that out. This is your rate forever. Now, the cons are, let's just say you do the permanent buy down and your rate's 6%, and then a year from now, rates are at 5 1/8, 5.125. You're going to be tempted to refinance. Well, if you do, all of that upfront costs that you ask the sellers to give you is going to be basically wasted because, or not wasted, because you did have some savings, but all of the remaining savings for the life of the loan is going to be thrown away because you're replacing it with a lower rate on a refinance. So I want you guys to know that the upfront cost on that could be wasted because you're now refinancing out of that program that had the long-term savings with a lower permanent rate right then. That's the biggest con of a permanent buy down. Now, there's not as much savings upfront from a permanent buy down compared to a temporary buy down. We saw up to $1,000 of savings on the temporary buy down on the first one. So let's look at the pros and cons of a, oh, I didn't change the, sorry, I didn't change the actual verbiage at the top. Sorry, went too fast today. The pros, significant savings up front. Again, this is on a temporary buy down, not a permanent like I have on the thing. The significant upfront savings is a lot. It is a lot. And one of the great things about the temporary buy down is, let's say you buy the rate down, okay? And your first interest rate is 3.75. You're not going to be tempted to refinance right away. But what if rates drop to 4? And you're like, wow, this is crazy. I kind of want to refinance, but I have all of this savings that I have built into this program that we just got. I don't know if I want to. Well, guess what? If you refinance out of a temporary buy down, the savings that you would have had gets refunded to you when you refinance. And the way that money, it's not quote refunded, but it's given back to you, and your principal is lowered by the savings that you would have had. So there's no loss in a temporary buy down if you refinance in the future. That's why I really like it right now. So buy now, refinance later. You can do a temporary buy down now without any fear of losing out on potential savings if rates drop. It's great in a dropping rate environment like right now. The cons are, if the rate is at 6.75 and you buy it down to 3.75 on the temporary for the first year, you still have to qualify at that higher rate because the note rate is 6.75. So you're still qualifying for the higher rate. So you don't get the benefit of helping somebody qualify, but buying down the rate permanently, you still have to qualify at the higher rate. So it's not permanent, and the rate will eventually go back to the market rate of that 6.75 that the loan is based on. The cons are on a temporary is it's harder to explain to a seller and a buyer on a temporary buy down because of the calculations involved. So I want to talk to you about what's happening on our team with over the last 2 years. You probably have this too. How many buyers have we worked with? Have we spent taking a lot of time going over what they can afford, what they want to buy, what kind of homes they're looking at, just to hear, I'm going to wait? It is the most consistent message that we're hearing right now over the last 2 years. We have, in the last 2 years, my team has over 200 pre-approved buyers that we are nurturing for our agents right now in our pipeline. That is a lot of people that we've been working our tail off for the last few years to get them ready. And guess what all of them are saying? I filled out, I did a lease. We're going to wait until the lease expires. We're going to wait till rates come down. We're going to wait till the crash. Well, we can talk about that in a second. We're going to wait. We're going to wait. We're going to wait. Well, what happens with all those buyers that are on hold when rates drop? What is it going to happen? So if we have buyers that are on hold, lower interest rates, and our inventory is lower because those people that have interest rates in the 2s and 3s, you think they're going to like just move because they like another house better? No, they're not. They're going to stick around. So there's a lot of people that would normally move within the city limits that aren't. So what happens when we add those two together? That equals a buyer frenzy. I'm telling you, it's going to happen. When we have over 200 people willing to buy, but they don't want to because either they thought the market was going to crash or rates were too high, and then you see the values stabilize and rates drop, what's going to happen? It's going to be a buyer frenzy. Now, when will it happen? We don't know. When rates will start to dip to a point that helps psychologically, but if real estate agents stay strong like we are showing they are, and buyer frenzy comes to a peak, we are going to see a pretty crazy little buyer frenzy come spring. So you need to be ready. You need to dust off those old pre-qualifications that you were issued, that you maybe have lost sight of those buyers. Call those buyers, let them know what's happening in the market, because it's going to be good next year. This has been kind of a blow, kind of a weird year psychologically for buyers, but they will come back in. So we've seen this, right? This was really interesting. I don't know if you guys have seen this, but it's all over social media. I wanted to show this to you because now I don't know if these facts are right. This is right off social media, but because you can't, I did some basic numbers and it's basically correct, but they're missing out a lot of the details. But if there was a listing price last year of $450 and they paid $50,000 over asking, with 10% out of pocket, I'm going to go back to that 10% down, not 10%. I'm 10% out of pocket, not 10% down. That's where they did a little mistake here. At a 4.5 rate, their payment was $3,028. That same listing price, if you just under at 10% down with a 6.5 rate, is the same payment. Perspectives, right? Now, there's a little bit of flaws in this, but that gives an interesting idea as to the perspective of how we need to be presenting the facts to our buyers to show them where we're at. So that's my little presentation this morning. I'm going to go ahead and stop my share here. Where is it? Where's my screen share? Stop share. There we go. And open up to questions because there's a lot that was in there. And I want to ask any questions that you may have regarding buy downs, what you see in the markets, and what I can do to help you if you have buyers that don't understand that temporary buy down. And guys, I'm telling you, every buyer that you've been working with for the last 2 years, you need to call, because after the holidays, because that's another quote, waiting period, right? After the holidays, it's going to get crazy. It does every spring here. And we all know the trajectory of the listings, and that goes up and down like a dinosaur's back every year. And the inventory always drops during the holiday season and then peaks back up when the buying season is here. And that's when people are, I think, are going to really take advantage of the lower rates. So this is the beginning of what I believe is where rates are going to slowly inch down. We may not see as many big days as we saw on Thursday of last week, but it will continue to go down and we will continue to see rates drop. There will be an up and down, like it's not a completely drop. There will be days when rates get a little worse. They're called head fakes and they kind of show what the markets are doing, but expect rates to get better now moving forward. Now, unless there's some real weird, hold on, sorry about that. Unless there is a weird happening globally with the supply chain and then we have inflation issues again, from everything we're seeing, the Feds are doing, I hate allergies, I apologize. But expect to see inflation come down and rates to come down. So that's the really good news, guys. We're coming into a slow time in our markets with the holidays, but do not slow down. This is when you really need to press into your buyers and the people that were thinking about listing their homes. Coming up this spring is going to be a great time to do so. Any questions on what's happening with rates? Any questions on buy downs? According to what you just mentioned, do you think it would be a good idea to hold and list a home after January 1st? That's a good question. I'm not a real estate agent, so I don't know all of the details in regards to the need for that. But if I was in your shoes today and I had a listing, knowing what I know about interest rates and how real estate and the days on market affects the buyer's perspective of that house, I may wait. But it really just depends on where that seller is mentally. It's a tough game. If they have to move to buy, if they have to sell to buy another house, apples to apples right now. But if they want to get more people to have a look at their home in the future, I believe there will be more buyers back in the marketplace next year. But I don't know. I don't think you should wait to get more money out of the home. I don't know. That's a good question. That's a really, really good question. I think let's look at Tina Tambor on Thursday and see what the different listing numbers are that's coming up right now, to see if the amount of transactions happening right now through the holidays versus the number of listings that are coming in the market can show us kind of what the trends are. So let's definitely jump into Tina Tambor on Thursday. And yeah, if you could, Noelle, if you're still there, if you could put the link to that in this chat, that would be great. Days on market are high now, and yeah. I mean, there's going to be a lot more that's going to be coming on, but there's going to be a lot more buyers out there as well. Believe me, we have them. They're all on hold, and we're doing our best to keep that line tight on those buyers, because they will eventually buy, and we need to be the ones that they go to. All right, so the trend right now is to cautiously float. We are floating rates right now, which means if a buyer came in today, we would most likely not lock in right away. Today, there's going to be a bond auction this afternoon. We've got some inflation numbers that are going to be out after everything's kind of readjusted. So we'll see what the markets have for this week, but cautiously float, and you guys enjoy your week. If you need any flyers, any presentation on the buy downs, any listing flyers, whatever you need, we've got everything. So don't be afraid to ask. Thank you for that link, Noelle. We do definitely appreciate that. Well, I'm going to stay on the call like I normally do. And again, this has been recorded, so we'll send that out to everyone as well. If you do have any questions, I will stay on. Otherwise, you are free to get after it this week. It's Monday. It's the Monday before almost the whole country takes off for Thanksgiving. That's about 10 days away, but it's going to start to trickle. So enjoy the holiday season if I don't see you guys in a little while. And it's not too late to put up your Christmas lights. I'm not too early. I'm sorry. It's too late if you're me, because I already did it. But if you need somebody good, pictureperfectholidaylighting.com. It's a good buddy of mine. He does a great job. Can you please give us an idea of what these 200 buyers price range and monthly budget is, so we can inform our sellers? Guys, they're everywhere. A majority of these buyers, I would say, are probably in the 3 to 6 range. And what I've noticed is those people that are a little bit more savvy, have a little bit more money in the bank, and when I say savvy, I mean they're just a little bit, they're in the higher income brackets. They have a tendency of not caring as much because they have disposable income. So once you get into the middle and the lower class, in lower incomes, I guess you could say, it's tougher because there's not as much discretionary income that we have for in the middle class, whatever, having towards paying a little extra on a rate and waiting to refinance. A lot of people are stuck because what they want is 400,000 and what they can afford is 300. So they're not moving forward because the house they really need is a little bit out of reach. But if you go into those buyers in the 800 and above, they may be able to pull the trigger because they have more discretionary spending. Unfortunately, when you have rate increases like this, it hurts the lower income family a lot more than it does the higher income. Yes, it still hurts everybody equally, but if you have a discretionary income, you can still make decisions. You can still move forward. It's just a little bit more painful when in some circumstances, it's not even possible. So those that it wasn't possible for are now going to be able to enter in when the rates do drop again. So that's exciting for them. A lot of our first-time home buyers will be able to enter again The Gen Zs are going to be able to, and again, that maybe have the lower income spectrum. So that's why a majority of ours are in that price range. And there are some that think doom and gloom is happening that are in the higher price range. They think the world is completely going to end and we're all going to live on Mars soon. So there are those as well. So, but that's at least what we're seeing. I hope that answered your question.
Sean, did you get my email about BPOs?
EPOs,
Yeah,
like early payoffs.
the broker price opinion.
Oh, I did not get that email. I'm sorry, I did not look through my emails this morning.
No, I sent it. I don't know if I got one of your emails and I responded, so maybe it just went to your spam, but we're just trying to get our PMI off, and I know I heard about a BPO, so I wanted to hear from you if there's anything else I should know about it or if I should
Yes.
try it out.
So if you have a home that has mortgage insurance and you have a low rate, if it's FHA, you're hosed because FHA has permanent mortgage insurance. If you have a conventional loan and you have mortgage insurance and you're at a position where the loan to value is you have a 20% equity position or more, you can you can work with the servicer of that loan to get an appraisal done. Has to be an appraisal done by that institution. You get an appraisal done. If the appraisal comes in at that, they will remove that mortgage insurance from your loan.
Okay.
It can take a while.
Okay.
So the servicer of the loan, you give them a call, they will do the appraisal. You have to pay for it. Usually it's between $350 and $450, something in that range. If it's a more expensive home, it could be a little bit higher.
Do you know how much mine was?
Yeah, you get that appraisal, and if it comes in, that can be removed, and you can get rid of the mortgage insurance without refinancing. So it's a great tool when you have that equity. So a lot of people are in that position and they don't know what to do. So maybe I'll put a little podcast.
Should I do that like more so sooner than later?
Yeah. If you believe equity's there, absolutely.
I'm pretty sure it is. I just is it different per your lender? Like do BPOs change based off of who you, because you know who I was with when you guys were with SunWest is who it's serviced through. So
yep. I mean, it really is it's an outside appraiser that does it. It's not them that does it.
Okay.
It's literally an outside appraiser. So it's all based on the same things you would use for a purchase. It's based on comps. So if you look in the area and you see there's 4 properties that are selling for that amount or more that you think your home is worth, it's going to come in because that's what they'll use. They'll use comps. They don't care. Mortgage companies don't care if there's mortgage insurance involved. They really don't. I mean, they're not making money on it. If they drop the mortgage insurance, they're still making their money. They don't really care. All they care about is the risk associated with it if it's not worth it. So that's why they'll make sure it is there if the comps support that it's not at that value. But they have no skin in the game when it comes to whether they want to keep mortgage insurance on there or not. It's really just depending on the value.
And then do there need to be updates or anything, or can I just as is get an appraisal and just based off of how much I owe on it? If it's 20%, then I'm good. Okay.
Yeah, it's just what you owe on it. You don't need to do anything else.
Awesome. Cool.
Yeah, good question.
Do it. Thanks.
For sure.
Great. Bye everyone. Have a good week.
You got it, guys. Enjoy your week, and we will talk very, very soon.